Hello friends, welcome to Shriram's. The topic for today's discussion is 21st Financial Stability Report of the Reserve Bank of India. What is the Financial Stability Report? Financial Stability Report is published by the Reserve Bank of India, taking inputs from the financial sector regulators, Security and Exchange Board of India, Insurance Regulatory and Development Authority, Pension Fund Regulatory and Development Authority, and other financial regulators. It is a periodic exercise for reviewing the nature, magnitude, and implications of financial risks that may have a bearing on the macroeconomic environment, financial institutions, markets, and infrastructure. These reports also assess the resilience of financial sector through stress tests. Why is it important? After the 2008 global financial crisis, financial stability has come to be recognized as an integral part of macroeconomic policy framework globally. It is even more important in the current global economic depression. What is financial stability? The term financial stability is interpreted as a persistent state of robust functioning of various parts of the financial systems, that is, markets, institutions, market infrastructure, enabling the system to face any endogenous or exogenous financial shock with minimal disruptive impact. What is the role of central bank in it? The role of central bank in any financial stability arrangement is considered central on account of their role as lender of last resort and the responsibility for the payment and settlement systems. They have a duty for supervising financial institutions, particularly large systematically important institutions. What is the 21st issue of Financial Stability Report about? Yesterday, Reserve Bank released its 21st issue of the Financial Stability Report, which reflects on the risks to financial stability and the resilience of the financial system in context of economic recession. What are the highlights of the report? In response to COVID-19, a combination of fiscal, monetary, and regulatory interventions on an unprecedented scale has ensured normal functioning of financial markets. Simmering global geopolitical tensions and economic losses on account of the pandemic are major downside risks to global economic prospects. Actions undertaken by financial sector regulators and the government to mitigate the impact of COVID-19 eased operational constraints and helped in maintaining market stability and resilience. Bank credit, which had considerably weakened during the first half of 2019-20, went down further in the subsequent period. The capital to risk weighted assets ratio of scheduled commercial banks fell to 14.8% in March 2020 from 15% in September 2019, while their gross non-performing asset ratio declined to 8.5% from 9.3%. Macro stress tests for credit risk indicate that the gross non-performance asset ratio of all scheduled commercial banks may increase from 8.5% in March 2020 to 12.5% by March 2021 under the baseline scenario, but the ratio may escalate to 14.7% under a very severely stressed scenario. Going forward, the major changes include pandemic-proofing poor people who are excluded financially. Well, that's all for today. I hope you enjoyed today's podcast.